Over the last few days, tensions between the United States, Israel, and Iran have escalated significantly. Military strikes have taken place, retaliation warnings are increasing, and there is growing concern that this situation could expand across the Middle East. Now, why should investors care about a geopolitical conflict happening thousands of kilometers away? Because this is not just a political news, this quickly becomes a financial markets event. Historically, almost every major geopolitical escalation in the Middle East have moved global markets, whether it was the Gulf War, the Iraq conflict, or even the Russian-Ukraine war in 2022, where global equities corrected nearly 10% in weeks while commodities surged. Whenever instability hits the Middle East, oil prices reach, inflation expectations change, currencies move, and global markets become volatile. So, in this video, let's break this down step by step and understand what this actually means for markets and investors going forward. So, first, let's understand the situation itself. Recent coordinated strikes carried out by the US and Israel targeted Iranian military and strategic infrastructure. Iran has reported strongly and warned of future retaliation, raising fear that the conflict may spread regionally. Now, markets are not reacting simply because of war headlines. Markets are worried about something much bigger: energy supply risk. The Middle East produces roughly 30% of global oil supply. Nearly 20 to 27% of the world's total oil trade passes through the Strait of Hormuz, one of the most strategically important shipping route on the planet. To put that into perspective, around 20 million barrels of oil move through this route every single day. Tensions affect this route even slightly. Global oil supply fears increase immediately, and historically, energy disruptions have triggered some of the biggest market volatility phases in history, including the 1970s oil shock when inflation globally surged into double digits. Now let's talk about the most important factor, oil. If there is one variable deciding market's direction right now, it is crude oil. Whether geopolitical tension rises in this region, oil prices immediately begin to show pricing uncertainty even without actual supply distribution. Fear alone creates what markets call a geopolitical risk premium. Analysts are already suggesting that escalation could push crude oil prices to $10 to $20 per barrel higher, and historically, every $10 rise in oil increases global inflation by roughly around 0.3% to 0.4%. That may sound small, but for central banks already fighting inflation, it becomes extremely significant. Oil influences nearly everything: transportation, manufacturing, electricity costs, and global supply chains. India alone imports about 5 million barrels of crude oil per day, which makes oil prices moments extremely important for the economy. So, the real question markets are asking right now is not whether conflict continues. The real question is, will oil supply be disrupted? Because that single factor can change market direction worldwide. Now let's discuss how global equity markets usually react whenever uncertainty rises globally. Markets move into what professionals call risk off sentiment. Investors begin reducing exposure to risky assets and shift money towards safer investment like cash, gold, and government bonds. Historically, during geopolitical stocks, global volatility index like the VIX often spiked 30% to 60% within days. You may notice markets opening weak, recovering suddenly, and then reversing again within hours. These environments become headline driven rather than fundamentally driven. Interestingly, history shows markets don't always fall long term during wars. For example, after initial declines during major conflict since World War II, the S&P 500 has historically delivered positive returns within 6 to 12 months in most cases. But short-term volatility increases sharply. Markets dislike uncertainty more than negative news itself. Now let's discuss bonds and interest rates. This part is extremely important but often ignored by retail investors during global tension. Institutional money usually flows into a government bonds, especially US Treasury bonds, which represent a market worth over $25 trillion. This demand normally pushes bond yield lower, but here's the complication: if oil rises sharply, inflation expectation increased again. And central banks like the US Federal Reserve, which already raised rates aggressively over the past 2 years, may delay interest rate cuts. So, markets could face a difficult setup: slow economic growth combined with persistent inflation. Economists call this environmental stagflation risk, and historically it creates unstable market conditions. Now let's bring the focus to Indian markets. For Indian markets, this situation becomes even more important. India imports nearly 85% of its crude oil requirement, making it one of the most oil sensitive major economies. Every $10 increase in crude oil can widen India's current amount deficit significantly and put pressure on the rupee. Higher oil prices also increase inflation risk, which may limit how aggressively interest rates can fall domestically. Central banks globally also have been aggressively buying gold with records purchases exceeding 1,000 tons annually in recent years. Gold works as protection against uncertainty, currency instability, and inflation risk. Silver usually follows gold, but with higher volatility. Fear in financial markets almost always moves towards safe haven assets first. Stay calm, understanding macro trends, and focusing on data instead of fear becomes extremely important. If you want deeper market insights and expert backed guidance during volatile times, download the app linked in the description because uncertain markets, informed investors always stay one step ahead.
Now let's talk about gold and safe haven assets. Whenever global uncertainty increases, capital naturally searches for safety. Gold has historically performed strongly during geopolitical conflict and inflation shocks. During the Russia Ukraine conflict in 2022, gold prices trailed close to 15% within months as investors hedged risk. Now let's discuss crypto markets. Crypto markets react extremely fast to global shocks because they trade 24/7. Initially, cryptocurrencies behave like risk assets and often move alongside equities, but interestingly, during prolonged uncertainty, Bitcoin has sometimes acted as a macro hedge, especially in regions facing currency instability. Bitcoin adoption has grown significantly within global crypto ownership, now estimated at over 400 million users worldwide. So instead of expecting a straight trend, investors should prepare for sharp volatility and rapid sentiment changes in crypto markets. Large moves in both directions become common during uncertain macro environments. So, what should investors expect going forward? Right now, markets are pricing uncertainty, not a full scale global crisis yet. This should be viewed as a volatility phase rather than panic. Expect headline driven moments, sudden gap openings, and fast reversals. Historically, markets stabilize once clarity emerges around energy supply and geopolitical escalation. Until then, discipline matters more than prediction. Moments like these test investors' psychology more than investment strategy. Emotional decisions during uncertain markets often destroy long term returns.